Welcome back to another episode of Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is a new guest to the show, Lyn Alden. She's the founder of Lyn Alden Investment Strategies. How are you today, Lyn?
I'm good. How are you?
Great. It's a pleasure to have you. You're an engineer and investor, and I was wondering if you could tell us a little bit about what your engineering background brings to your view of investing.
Sure. So I started out over a decade ago in electrical engineering, and then I moved into engineering management and engineering finance. So I kind of blend the more technical background with a financial background, and it gives a couple insights. And one, it helps me analyze certain tech stocks, which is helpful. But from a macro perspective, it also it just kind of creates a really strong quantitative background when it comes to analyzing markets. And in particular, my specialty was control systems. And so it was kind of like analyzing feedback loops and seeing how different variables affect an overall system. So I found there's a lot of similarities between kind of control theory and macro, because whenever there's like an event happening, there's always a policy response or some type of feedback loop that happens. And I feel like a lot of investors often ignore that piece, but the control systems background really kind of emphasizes that sort of thing.
As you say, the feedback response or the policy feedback response really kind of goes into the next thing I wanted to dive into here. You have a great website with a ton of free content that I found unbelievable, actually, with the amount of information there. And you have an article from April 2019 about the 4 debt bubbles. So we have student debt, per capita healthcare costs, unfunded state pension liabilities, and federal debt. So let's dive into a little bit about how things have changed since you've written that article.
Yeah, sure. So I originally wrote the earlier draft of it in 2017, and back then I had 3 major bubbles listed. And then when we started to get the deficits blow out in 2018 and 2019, I added the 4th bubble, which was the federal debt. So over time, I've kind of added to it just because we've kind of blown up more bubbles. And this was all written, of course, pre-COVID. So a lot of these are larger now than they were then. So some of the bubbles I identified were, many of them are well understood, but it's incorporating these into market views, which is tricky. So one of the bubbles is student loan debt. A lot of people look at overall consumer debt, household debt, and it's been going down in the past decade as a percentage of GDP, mainly because people lost homes and therefore they walked away from mortgages. If you look at overall household debt, it did go down as a percentage of GDP, but if you break it down into the different types of debt, most of the household debts other than mortgages went up. Student loan debt went way up. That was the biggest driver. Also, like things like auto loans, kind of the lower quality loans that aren't really backed by hard assets, they generally went up. And student loans have just gone up dramatically. I mean, we've gone to well over $1 trillion in a single decade. So that's been a really massive increase, especially for the next round of spenders, which is millennials. And many of them are kind of holding back on home buying, even holding back on marriage and things like that because they have so much debt. Another bubble I identified was healthcare costs. So the United States has the highest per capita healthcare costs in the world. Not even really close. I mean, the only one that comes close is Switzerland, but most other countries are on the order of roughly half per capita of what we spend. And it's challenging because we don't get necessarily a ton for that. We don't live longer. We don't have lower infant mortality rates. Our healthcare system is kind of ranked average among developed countries. Now, it has pros and cons. So for people that are very well off, our system can do pretty well. But for the median person, this is a pretty big drag on the economy, especially considering if you're an employer and you have to cover a big part of your employees' healthcare costs, having the highest healthcare costs in the world gives you kind of an anchor to your competitiveness compared to many of your international peers. So that's kind of been a growing issue. And so far, reform hasn't really fixed that, right? So it was expensive before we got the Affordable Care Act, and then the Affordable Care Act didn't really make it any more affordable. It's just kind of been a multi-decade issue that's been building. And then 3, this is both in the U.S. and worldwide, whereas the first 2 are more U.S. specific, but in the U.S. and in many countries, there's unfunded pension liabilities. And in the U.S., it's the biggest problem is among states. So many states are just trillions of dollars behind on their pension liabilities. And they often target 7% rates of return, which is really hard to do in such a low interest rate world. It makes them take on more equity risk, more private equity risk. So they kind of go out on the risk spectrum trying to get these gains, and they just keep falling farther and farther behind on their commitments. And unlike the federal government, states can't print money, right? So they're reliant either on, they could potentially default, or they're reliant on federal bailouts to get that money. And then last is the federal debt, which is a different beast than the state debt, but even before COVID, we reached debt to GDP levels not seen since World War II, which is the only other time we were higher than this. And now that COVID struck, we're kind of right up against that World War II peak. We're at about 120% debt to GDP. And historically, this is handled by significant currency devaluation, both in the U.S. That's how we kind of got out of the World War II debt. We inflated a lot of it away. And if you look abroad, that's just historically over very long periods of time, sovereign debt bubbles are generally handled with currency devaluation.
As we look at the currency devaluation and the central bank printing, we saw recently the federal bank balance sheet expand dramatically. Has that really outpaced their future projections of what they were planning to do?
Yeah, because the funny thing is that they never really factor in recessions into their forecast, right? So the Congressional Budget Office had a 10-year projection of what the federal debt was going to do. But I've been saying ahead of time, they just assume there's no recessions ever. So even though we were 10 years into an economic expansion, the longest one in human history, they were still saying, okay, for the next 10 years, we're just going to have smooth growth, no recessions. And of course, we got, the biggest recession in modern history, with the catalyst being the virus, but the debt also contributing a major factor to that. So that we already hit levels of debt that they didn't expect to reach for like 5-10 years.
So in your opinion, Lyn, how is this going to affect the US dollar going forward? We've seen the central bank swap lines increase dramatically, and it seems you've compared them to 2008 and 2012. So how are we going to see that develop going forward?
Yeah, so there's two main forces for the dollar. One is that because we're the global reserve currency, there's a lot of dollar-denominated debt outside of the country. There's at least $12 trillion worth of debt at sovereign level and non-financial corporations. So those are debts that are owed by companies outside the United States, but the debts are still denominated in dollars. And then also offshore banks outside of the U.S., they have another 10 trillion or so in U.S. debt. And all of that debt kind of represents demand for the dollar that's inflexible because they have to get dollars to service their debts unless they default. So that kind of creates, especially when we have a recession, when we have global trade slow down like we saw in March, that can create kind of a dollar squeeze where everybody needs dollars at the same time just to service their debts. So in addition to the dollar kind of being perceived as a flight to safety, it's really more about flight to necessity, right? Because they need dollars to service their debts. And so generally what happens, this happened back in 2008 in a big way. It happened a little bit in 2012 during the European sovereign debt crisis, which is whenever you have like a global rush for dollars at the same time, the Federal Reserve provides swap lines to other central banks, which means they give them some dollars in exchange for holding some of their currency like euros and yen as collateral. And the reason the Fed does that is because if they don't, one of the other options for the foreign market to get their dollars that they need is to sell U.S. assets. Foreigners collectively own about 40 trillion in U.S. assets, and we own about 29 trillion in foreign assets as Americans. We have that 11 trillion difference, and so in particular, the foreign sector owns about 7 trillion in U.S. Treasury debt. That's kind of their most liquid way to hold it. But they also have stocks, they have corporate bonds, they have real estate. So if they have a scramble for dollars, they historically sell treasuries to get dollars. So when we saw the big dollar spike in 2015, 2016, they sold treasuries abruptly to get dollars. And then again in March, when we had this dollar spike, this dollar squeeze, foreigners over the course of March and April sold about 300 billion in treasuries, virtually, just very quickly. And that pretty much broke the treasury market. So the Federal Reserve repeatedly cited that the treasury market became illiquid. It ceased to function effectively due to lots of selling, especially on the long end, the long duration stuff. So that makes the Federal Reserve say, okay, stop selling our treasuries. We'll give you some dollars. You give us some yen. And when there's no dollar squeeze, you can pay us back. So what we've seen is they lent out $450 billion to foreign central banks, mainly Japan and ECB, but also about 10 countries total, or 10 central banks total. And so far, about half that's been repaid. So they paid, it's down to about $225 billion as of this discussion that they paid back. So far they're paying it back about the same rate that they paid back in 2008. And so far the swap lines were smaller a little bit than 2008, bigger than 2012, smaller than 2008. But we don't know if we're at the end of this yet. So we could get another round if there's more virus issues or more economic issues later this year.
So in the long run, Lyn, where do we see the U.S. dollar, or where do you see the U.S. dollar going from here? I know you recently spoke with Brent Johnson on Real Vision. So maybe give us a little bit of a contrast of how he sees things and how you see things developing.
Sure. So longer term, I expect the dollar to probably go down as my base case compared to many other major currencies. And the reason for that is if you look back since 1971, there's been three really large dollar cycles. So the first one, we started from a low point in the 70s, and then we had a big spike in the dollar into the mid 1980s. That was when Paul Volcker rose interest rates. We had really high real interest rates. So we had a really strong dollar. They reduced that with the Plaza Accord. Then we got another dollar spike in late 90s, early 2000s. That, of course, broke a lot of emerging markets, and that eventually was kind of popped around the dot-com bubble a little after. And then now we're kind of in the third dollar spike. So ever since 2015, when the Federal Reserve stopped their third round of QE, and then eventually did quantitative tightening, we've been in a very strong dollar environment again. And this historically, it puts a lot of pressure on the world because they have high dollar-denominated debt. But then it also puts pressure on U.S. corporations because it makes them less globally competitive. Ever since we had that repo crisis at the end of last year, I became more dollar bearish, right? Because we shifted from having relatively tight monetary policy compared to the rest of the world to having among the loosest monetary policy in the world. So we're doing QE at a faster rate than most other countries. And I expect this to continue, not necessarily every quarter, but over the next several years. And so my base case is to see a notably lower dollar in the years ahead. Now, other people, like such as Brent Johnson, some other dollar bulls, have argued that the offshore U.S. dollar-dominated debts are going to kind of override that, and that they're going to create a ton of demand and a ton of safe haven demand for the dollar going forward. So that's kind of the dollar bull versus dollar bear argument is kind of comparing. On one hand, you have all that offshore debt, which creates a lot of demand for the dollar. But on the other hand, we're probably going to be running larger deficits, faster money printing, and we also are starting from a very expensive point for the dollar. So there's a lot of downside potential.
Let's turn a little bit to another article you wrote about contrarian investing and how you seem to check valuation measurements to determine how to allocate capital.
Sure. So as a baseline, many investors, they look at what's done well recently and they invest in that. And that can work well if you do it in a sophisticated way, like trend following, right? So if you have a systematic approach to following what's done well and then getting out of it when it stopped doing well, that's a pretty good approach. Another approach for the long term is to find out what's done poorly, what is cheap, and why it's cheap, and then why it's likely to have a reversal in the future. If you look back, for example, over the past several decades, every decade had a different region of equity outperformance. In the 1980s, it was Japan. They outperformed other markets by a long shot. In the 90s, you had the United States and Europe do very well, our equity markets. And then when they became very overvalued in the late 90s, emerging markets, which were beaten down by that strong dollar that happened, when that reversed, emerging markets did very well. So over the 2000s, emerging markets were the big outperformer. And then in the 2010s, it's been the United States again, right? So the emerging markets got too expensive, the dollar got strong, and we had this period of U.S. outperformance. Contrarian investing for me is to use somewhat of a counter-cyclical approach, right? So when things are cheap, I over-allocate some extra money to it. When things get expensive, I pull back, especially when combined with just looking at different valuation metrics, looking at kind of sentiment indicators and things like that. So I use treasuries as a counter-cyclical approach. So when the U.S. market's expensive, I get more into treasuries. U.S. markets become dramatically more expensive than foreign markets. I carefully allocate to forward markets a little bit more. When we have kind of a big commodity sell-off or when gold dips, I add to that, things like that.
Perfect. So what are some of the, let's say, sectors that have been overvalued or overbought and something that you're kind of switching into? Obviously, we're more focused on gold, Palisade Radio. So tell us a little bit about kind of where you've seen the tides shifting from and to.
Sure. So over the past 5 years in particular, U.S. mega caps have been the big outperformer. So the NASDAQ stocks and the big stocks in the S&P 500, they're the same stocks anyway. So companies like Apple, Google, Alphabet, Amazon, and also just software in general. So we've had software valuations reach extremely high levels that are hard to justify. And a big reason for that is because we've been in this very disinflationary environment, right? So when you have very low interest rates, stocks that are perceived as growthy, things that have kind of a long runway of growth, they can get bid up to very high levels because they're compared to very low bond yields. And if they're perceived as not very cyclical, and if they're perceived as having a long growth rate with a very low discount rate, when you're kind of discounting all those future cash flows, that can create very high valuations for that sort of companies. In my view, at this point, though, many software names are really overbought, really expensive. There's somewhat more value in some of the hardware tech names. I think semiconductors, because they're more cyclical, they have more opportunities in them sometimes, but even they're starting to get pretty heated at this point. I think for several reasons, including a potential shift to a more inflationary environment this decade compared to last decade, and with the potential for some antitrust actions against some of these mega caps, I think this very expensive kind of area could face more headwinds in the coming decade. And on the other end of the spectrum, commodities are at historically cheap levels compared to many metrics, especially compared to equities. So that includes gold as a main thing. So I've been long gold and gold miners since October 2018. It's been a pretty good investment so far. I've been cautious of the base commodities, but recently, after this COVID sell-off, I've been getting more and more optimistic on things like copper and oil at these pretty low levels. When looking out over the multi-year long term and looking at producers that can have low cost production, strong balance sheets, and can kind of get through the hard times if we should see more weakness in later this year or next year.
Recently, you wrote an article which is very timely for this discussion about gold, and part of what you touched on just now was interest rates. So give us a little bit about how you see gold versus interest rates and why the best case scenario for gold is high inflation and low nominal yields.
Sure. So like I said, I went long gold in 2018 and gold miners and royalty companies. Over the course of those couple of years now, we've had some pullbacks, and I've been adding on those pullbacks. And so the question of this article was, okay, now we've had this pretty big run. Gold's outperformed the S&P 500 pretty significantly. So should we start being worried about corrections or the end of a bull market? So my answer was, at least for the second question, no. I think we're going to get corrections along the way. I'd be happy to buy those corrections, but I don't think this bull market is anywhere near the end. I think we're going to reach, far into the all new nominal highs in the years ahead. So I covered four main reasons for that. One is, so I track gold relative to money supply growth, which is kind of a truer measure of inflation, because even though consumer price inflation, by some ways to measure it, has not been very high over the past decade, money supply itself has grown at a very quick rate. It's just that most of that money supply led to asset price inflation, financial asset price inflation, rather than consumer price inflation. So because gold's a financial asset, it responds well to both those types of inflation. So even though we haven't had a lot of consumer price inflation based on some ways to measure it, we have had just the sheer amount of money supply growth. So I have a couple different ways to quantitatively track gold relative to the growth of money supply, both on a per capita basis and on a countrywide basis. You can also do the comparison with global money supply. So there's a couple different ways to measure it, and you can get kind of, the conclusions can range from roughly fairly valued to undervalued for gold at this time. So my case has been more like it's fairly valued after this run up, but that's in a world of many things that are overvalued. So the fact that it's fairly valued, but that money supply is still growing quickly, I think creates a very good case for gold. And then for interest rates, many people know that gold is inversely correlated to real interest rates historically. So whenever real interest rates are high, that tends to be a headwind for gold. So people often think of gold as an inflation hedge, but it's really more of a negative real interest rate hedge. For example, in the 1980s, inflation was pretty high, but because bank yields and treasury yields were even higher, that was actually not a very good environment for gold, because if you're having inflation at say 5%, but you can put your money in a treasury bond and get 8%, right? So you're getting 3% real yields. And so that represents a pretty sizable opportunity cost for owning gold. However, if you have 1%, if you have 2% inflation, but yields are only 1% on treasuries and bank accounts, that means that you're effectively losing 1% per year over the long term if you hold those treasuries and if you keep money in those banks. So even though that's a lower inflationary environment, it's also negative real yields, which tend to be very good for gold. Over the long term, looking at ever since the early 1970s, whenever we have these periods of low or even negative real interest rates, they tend to be very good for gold. So we had that in the 1970s. We had that again around 2011, and we're starting to experience that now. So it's been a very good environment for gold to have interest rates this low, real interest rates. Of course, the best case scenario is when you have high inflation and that for some reason or another yields are very low, either because the Federal Reserve caps yields or another thing. So because that creates very, very deeply negative yields like we saw in the 70s, and that can be very good for gold. And then just also in my article, I covered how gold still has pretty strong momentum versus equities. So gold broke out over its 50-month moving average against the S&P 500 if you look at the gold to S&P 500 ratio, and that even though among us, kind of niche investors that do invest in gold, many of us are bullish on it. So it can seem like too many people are bullish on gold, and so that's why we can get corrections from time to time. But gold still remains very underowned in the broader investor community. So, for example, the classic 60-40 portfolio has no gold exposure. Most pensions have virtually no gold or gold miners. 401k plans are pretty much without gold. Insurance companies, all these large portfolios are generally with little or no gold exposure, and a lot of exposure to these bonds with negative real yields. So over the long term, the next 5 years or so, I still think there's a lot of potential for gold to do well, even though we're going to get some corrections along the way naturally.
So why do you think, Lyn, that gold is underowned in those categories, and what do you think could change that?
Well, even though it's a roughly a $10 trillion asset class, that's actually pretty small compared to say equities or sovereign bonds, right? So it's still a pretty small asset class. Silver is even more so. Silver is a tiny market. Gold's like a medium-sized market. And two, we've just had a 40-year bond bull market, right? So ever since interest rates were risen very high in the early 1980s and then slowly reduced over time due to disinflation, that's been a very good environment for bonds, right? Starting from high real yields and then slowly going down. So you get all of that interest rate return, and then also you get tons of capital appreciation. So it's been a very good trade to just buy bonds and just hedge that. So, but now that we're hitting the lower bound, so many investors today were never alive back in a time when bonds were not a good investment. We haven't seen kind of this more secular shift to valuing something like gold over cash and bonds yet. We've only seen that kind of among niche investors.
When we look at gold that's held by central banks, how do we think about what they're holding and how does that affect each of these countries going forward? And maybe contrast Russia with the U.S. for us.
Yeah, so over the past, let's call it 5 or 6 years, most central banks have not really been accumulating their treasuries anymore. So if you look back over several decades, central banks, due to the U.S.'s reserve currency status, usually we run big deficits with the rest of the world, and then those countries reinvest those deficits, those dollars, into buying our treasuries and using them as reserves. However, whenever we have these strong dollar environments, foreign central banks usually stop accumulating treasuries, or at least slow down their treasury purchases. So over the past 5 years, in this strong dollar environment, they've in some ways de-dollarized a little bit. So they've really stopped accumulating treasuries. And many central banks, especially some of the emerging market ones, have accumulated gold. And the biggest buyer has been Russia. They've been kind of buying gold hand over fist pretty much for the past 10 years. And they've been really kind of leading the charge against de-dollarizing, because they have some countries just haven't been buying treasuries, but they've actually been selling their treasuries, and they've been just more adamant against having a lot of dollar exposure. So Russia's interesting because if you look at all countries, even though no country's on a gold standard now, if you look at, like, theoretically, if they did a gold standard, how much gold do they have relative to their money supply, right? What percentage of their money supply could they back by gold? The highest country in the world by that metric is Russia. If you look at the U.S.'s official gold reserves compared to our money supply, their value of gold is worth about 2.5% of the U.S.'s broad money supply, whereas for Russia, that figure is closer to 19%. So they have a very much higher ratio of gold relative to their broad money supply, which is interesting because they also have pretty low debt, and they just have very sizable reserves.
So does that translate into more security going forward for that central bank?
I think it can. Yeah, they have higher real interest rates than us. So they have 4.5% yields interest rates last I checked, compared to only about 3% inflation. So that gives them positive interest rates. It's good for their banking sector. Now Russia has their own challenges, right? So they came into this year with a government surplus and a trade surplus. So they were actually in a really strong position. But because of the COVID-19 reduction in oil demand and gasoline demand worldwide, their big export energy has been hit pretty hard. So they're going to have deficits this year. So for them, a lot of it kind of comes down to how well oil rebounds. They, I think, were pretty smart to kind of build up this big reserve status, so that as they're in this price war with shale and with Saudi Arabia, they have a lot of reserves that they can kind of fall back on to get through this for the next couple of years.
So when we think about how to play this bull market going forward, Lyn, in your opinion, where are some of the best places for investors to look for value and for possible gain in the gold sector?
Sure. So the past, ever since 2018, I've been focusing mostly on gold itself, and then some of the larger cap gold stocks. So that includes the royalty companies and some of the major names. But some of those now have been bid up pretty well. They perform pretty well. I think there's going to potentially be more value in the mid cap and the smaller cap space, as long as you focus on quality. So I think we could have more kind of performance from there. But I would kind of stress having kind of broad sector exposure for most investors that are not specialists. And then I think silver could start doing very well. So we've had a long period of gold outperforming silver, and that's normal in this stage of the business cycle. So when we have a slowing business cycle, as we've had since 2018, we've had then of course we had the recession happen. So we've had a period of gold outperformance. But when we hit that part, maybe in 2021 or so, when we start to get more reflation, so we have somewhat of a jobs recovery, but also just really large deficits that are monetized by the central bank, that could be a pretty bullish environment for silver in particular. So even though gold's doing well, we could start to see silver catch up. And then for, like I said, copper, oil, metals like nickel, I think some of these other base commodities could start seeing signs of life, going forward as well. I recently highlighted Freeport, for example, as a stock I like. They have both copper and gold exposure. So I think going forward, there's ways to take kind of a little bit more calculated risk, whereas in the past couple of years, kind of the safer ones have really been the good performers.
And as somewhat of a more, let's say, an objective observer of many sectors, Lyn, do you give any weight to the historical gold to silver ratio, or how do you go about, like, what is your mental framework to think about how undervalued silver could be towards gold?
I think it's a useful ratio to follow. I think it's a mistake to focus too heavily on it, like to assume that because the ratio has historically worked well, that it must work in the future, or that because the ratio is high that silver must outperform. So instead, I view it as a matter of probabilities and as one variable among many variables. So as I pointed out, in these more disinflationary periods, especially later in a business cycle, because silver has that partially industrial component, and because it's more volatile in general, investors tend to prefer gold, the safety of gold, and kind of that hedge against chaos. Whereas when you have a more reflationary environment, that's when silver can do well. So there's a couple of things that could be in silver's benefit in the years ahead. One is it's a much smaller market. So if you get even investors want to put half percent of their portfolio in silver, that's just a massive amount of money that could come into a pretty small market, right? So it's a much smaller market than gold. So you could have a pretty explosive run there if it were to happen. And then two, you could see industrial demand pick up. So you could see, it's heavily used in electric vehicles. It's heavily used in solar panels. It's just heavily used in electronics in general. And there's not really a lot of new supply. It's mostly a byproduct metal. Overall, the amount that it's mined is still pretty scarce. The amount that's held above ground is still pretty scarce. So if you see that higher investment demand, especially if the investment demand competes with all the industrial demand, we could easily see higher prices. And a big comparison I've been making is that the 2010s and 2020s look a lot like the 1930s and 1940s. So in the 1930s, we had it was a more disinflationary environment, right? Because we had that big private debt bubble collapse. We had that period of deflation in the early part of the Great Depression. And then of course when they devalued the dollar and they did things like that, we saw more reflation, but we never really saw high inflation. Whereas in the 1940s, we saw massive government deficit spending, and that was monetized by the central bank. They basically did QE back then, even though they didn't call it that. So we had a more inflationary environment. And if you look at the performance of gold and silver in those decades, so gold did better in the 1930s and silver did better in the 1940s. Now, of course, gold was fixed to the dollar at various amounts during those times, where silver was free floating, right? But if you look at just the ratio themselves, that more inflationary environment was really good for silver. And I'm kind of viewing this the same way, that this, the past several years have been really good for gold because we've had a slower growth, more disinflationary environment. So it's been really good for long bonds. It's been really good for gold. And going forward, I think we're in an environment where even though gold will continue to do well, most likely, it could be a pretty good environment for silver in particular.
Scrolling through a little bit of your Twitter feed, you were also saying that if Tesla actually starts selling a reasonable amount of vehicles, instead of owning the actual stock, you would much rather own base metal and silver miners, right?
Yeah, I've had some debates with people about Tesla. I think at the current valuation, it's too expensive. Even if some of the more optimistic projections for Tesla work out. So say they go from selling less than 500,000 cars a year to 5 million, or because they're currently priced more than Toyota, and Toyota sells 10 million cars a year, right? So people are kind of assuming that Tesla's going to sell millions and millions of cars per year in the future. And if we start getting a really big explosion in electrical vehicle sales, now they use more copper, they use more silver. In addition, the electrical grid needs to be upgraded to support all that kind of new energy that's kind of flowing over the grid instead of through the gas lines. So you need a lot of copper for that sort of upgrade. You'd also kind of need steel, nickel, steel for the grid updates, nickel for the batteries, cobalt, all these different kind of metals. We've had a pretty significant period of underinvestment in a lot of commodities, especially copper. And so if we start to see multiple sources of demand increase, so for example, if we see India's economic growth accelerate, they've so far been a pretty small consumer of copper, but that could go up pretty dramatically. Electric vehicles themselves are not a huge source of copper, but that's still incremental increase compared to what's been happening with internal combustion cars. So I do think that if you're bullish on a lot of these kind of renewable technologies, things like silver at these lower levels could be pretty interesting.
Absolutely. In wrapping up, Lyn, is there anything else you'd like to touch on?
No, I think that pretty much covers it. Going forward, over the next several years, we're probably going to see very large government deficits, both in the U.S. and other countries. And because sovereign debt levels are already so high, historically, that means that the central banks will be the primary buyers of all that new debt issuance. So essentially, the governments will be running very large deficits, and those deficits will be monetized by their central bank. So that's a very good environment especially for gold, but also just for kind of scarce assets in general, especially because many of these countries, especially I think the United States, will cap yields if needed, right? So they did that in the 1940s, which means that they can essentially buy as many bonds as needed to cap yields nominally. And because there's no free lunch, there is a cost for that. And usually that cost comes out in the currency. So I do think going forward, we're likely to see all currencies or most currencies devalue versus, say, gold and silver, and for some of them to devalue more quickly.
Some excellent historical precedents to kind of contrast to these times, Lyn. Why don't you give us a couple places where people can find more information from you?
Yeah, sure. So my website is lynalden.com. I have a lot of free content. I have a free newsletter, and then I have also a research service that some people can sign up for. And then on Twitter, I'm at Lyn Alden Contact, and I do a lot of charts and things like that there.
Both excellent resources. Thanks for your time today, Lyn.
Yep, thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?